Hello, everyone, and welcome to this week's special live event of the U.S. Market Update. My name is Zach. I'm one of the team here at Elliott Wave Options, and I'll be facilitating this session tonight with Rob Roy. Every week, Rob has his weekly U.S. Market Update that most of the time is a recording that's posted afterwards, and then, of course, comments are replied to after they've been posted. But for this week, we're doing a live special event. We've done a couple in the past, and we've found that there's been some positive reviews. So every now and then we like to come on live and have it as a special live event versus just the recording. So welcome and thank you to all those that have taken the time on your Friday night to view this. This is our live disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We do have this available to be read on our website in full detail there, or feel free to take a screenshot if you like, but that's the main point to take away. I do believe after Rob's going to get through his U.S. market update presentation, that'll open it up to a few questions at the end. So please feel encouraged at any point throughout this session to write your question in the chat window there, and there will be potential of it possibly being addressed. So definitely take advantage of this real-time interaction with Rob. And thank you again to all those that took your time out of the Friday night to view this live event. So without further ado, I will go ahead and introduce the man of the hour. That's Rob Roy.
Thanks, Zach. Welcome, everybody, to our another edition of a live event. We did it last weekend. Hope everybody enjoyed my birthday holiday weekend. Thanks to everybody that posted happy birthday wishes. Appreciate that very much. And just thought we'd go ahead and jump in here and do it again, if you don't mind. So whether or not you like the live events, the recordings, whatever, please don't forget to click in and hit that like button. You know how it works, or better yet, hit subscribe and you'll be notified immediately when one of these videos or live events like this is posted. Go ahead and bring up my video. There I am, complete with a hat and everything. So welcome, everybody. All right, so before we get to the charts, as you know, it's Friday evening, so the futures market is closed, and welcome to another edition of Doji Day. You don't know what I mean by that. We've had a few of those in the past. You'll see as we go through the charts, awful lot of dojis on the charts. The financial news that came out, or the economic news, I should say, that came out today was the non-farm payrolls, coming in at 372,000 jobs added when 250,000 is expected. So there's all kinds of chatter of maybe the Federal Reserve can engineer the soft landing. Maybe. And then they talked about how the 2-year stayed above the 10-year. But let's take a quick look at the yield curve, because we did have another inversion this week. So if you go over here and take a look at where the 2-year is right there, and then come over to the 10-year, you can see maybe the 2 years above the 10, but there was an inversion intraday throughout the week. So another signal that there is likely a recession coming. So maybe it's a bit hopeful thinking that we can avoid any sort of a official recession. I think it's going to be one. The question is going to be, how deep does it get? Now, one thing that is encouraging is the long end of the curve here is starting to steepen a bit. So that's a positive, but so many people watch the 210, and when you see them at roughly the same spot, or maybe the 10 even a little bit lower than the 2, that's the inversion, and that's where the recession comes in. If you're not familiar with the bond market, you just think about it from a common sense standpoint. You should earn a higher interest rate to hold a bond or treasury 10 years versus 2 years. So if you're buying treasuries and you can get the same yield on buying a 2-year, why in the world are you going to buy a 10? And you can do it multiple times and earn so much more interest. So that's what they're talking about as far as the yield curve inversions, et cetera. All right, so here's the SPY update. Our chart, and you can see not so much of a doji here, but there's going to be other ones in the U.S. markets. We take a look at this, and one thing I think that we need to pay attention to is the volume. We just don't have the volume. We talked about this on Tuesday night in our Trade Finder, and if you haven't signed up for Trade Finder, go ahead and do that. You can do it underneath this video. We do it every Tuesday night at 9 p.m. Eastern time, where we look at the markets, we look for trade ideas, and we have a Q&A at the end there as well. It's a lot of fun, again, free, so join us. But we talked about how impulse moves can start on lower volume. But if an impulse move is going to continue, volume needs to kick in. So why are we talking about this now? Well, we do have the possibility. I still think we're going to make a lower low, but there's the possibility when you look at this Elliott wave pattern and the Fibonacci levels that the bottom is in. We have this nice doji here that was within the tap box, the time and price projection of the wave 5. We had a 38.2% wave 4 correction, 61.8% fib extension. Is that it? We're moving to the upside. We've got a zigzag pattern right here that shows that we could move up all the way up to just above 400, which makes a lot of sense because that gets that last gap filled, or the first initial gap on the way down. Then we'll see what happens. But if we don't get some more volume soon, I'm not sure we can even climb that high. Maybe we can. Maybe we can continue to drift up there on low volume. But at some point in time, we've got to get this volume at least to average, if not above average, if this impulse is going to continue at all. But pretty interesting charts there with the zigzag and the C wave extension being exactly at the spot where that gap would get closed. Now we look at interest rates, and you can see that interest rates are moving back to the upside. So here, Elliott wave again, hitting that 38.2% fib level on the wave 5. So that was resistance. You have a wave 5 that doesn't extend more than 100%. You're going back to the previous 4, and that's exactly what happened. And look, here's another zigzag. So just Elliott wave all over the place. You have a 50% B wave correction that yields a 100% extension. And there we are. We went right down to the 100% extension on interest rates coming down, and they've been rebounding significantly, moving back to the upside. What caused the rates to come down? Was money leaving the equities market and coming into the bond market? I think so. Is money now leaving the bond market and moving back into the equities market? Or are the people that wanted to buy bonds just done? We've had as much volume coming in as a lot of it was international volume, people from around the globe coming in and buying our securities that had a higher rate than what they're earning. There's even been chat about, could Japan, all the years that Japan has kept their rates low, could they actually be looking at raising rates down the road? Their inflation data is still nowhere near as high as ours, but it's ticking a little bit to the point where at least there's some speculation. And then the commentary was that would send global shockwaves. Really? I don't still know that it would be that shocking to see Japan raise rates. But I don't know. We'll see. Maybe it'll affect the markets more than I'm giving it credit to. But it would be certainly surprising because it's been so long. But we'll see how that plays out. But rates moving back to the upside, that could, if it is money leaving the bond market, give a little bit of support to this impulse move, get us up, get us to that C wave extension, get that gap filled. But as I said, the volume has to come from somewhere. And so far, it's just not there. Looking at the dollar needed a break. We talked about this last night in our insiders meeting, which is for our alert subscribers at EWOtrader.com. And that Thursday night meeting is for alert subscribers only. Tuesday night with Trade Finder, we open that up. We do it live stream through the various social media outlets, but Thursday night is for alert subscribers only. And we talked about how the dollar needed a break. It tried even after the doji yesterday to run up again, but it came back down. You can see we're still just a little bit overbought on the dollar from the 10-day moving average, the separation there. We're within this tap box. Does the dollar go higher? I think it kind of makes it up to that wave 5 target, but perhaps it rests a little bit first, maybe even pulls down just a little bit. So when you're looking at that, you're thinking, okay, what's the effect on the metals? Well, with this big move to the upside, breaking out of this triangle that we had right here on the dollar, you would think that that move in the dollar wasn't too good for the metals, and it wasn't. And we had downside trade puts on the SIL, which is not silver, but it's the miners, the silver miners. And look, here's another doji, or excuse me, another zigzag pattern right here, all the way down, right to the 61.8% fib extension because the B wave was 38.2. So when you have a 38.2% B wave correction, you look for a 61.8% extension. So if the dollar does start to come down and we're at a level of support here, maybe we get a little bit of bounce out of the metals. Certainly due for one. They've had a really rough time, but it's been because the dollar's been so very strong. More news that came out today, if you've been watching, was Elon Musk saying that he's pulling the plug on his deal to buy Twitter. Now, you can see what happens now. We're going to go into a legal fight over that. He claims that they're not giving him the information on how many spam accounts they have, and they're saying that they have. So the argument begins, right? I don't know that anybody's too surprised about this, but look what happened on these charts today. I wanted to show you this big move to the upside here. Now, there has been a pretty decent little triangle here on Tesla, and we had the doji here on the 6th, and then boom, boom, 2 straight moves to the upside. So you see Tesla breaking to the upside and Twitter breaking down, and Twitter's in a, pardon me, a 5-wave impulse pattern to the downside. Did somebody know something? Because the news wasn't officially released till after the market closed today. So that's when you start to think, people know something. So you see Tesla was moving up on the day, Twitter was moving down. Everybody knew that Elon had gone to meet with Twitter, but the speculation was maybe he was going to try to negotiate the deal a little bit. I don't know that it was widely known that he was just going to flat try to pull the plug on the entire deal. But yeah, when you see things like that, it's just interesting. Tesla up, Twitter down. Nobody knew that until after the close. Really interesting stuff. So Bitcoin is holding 20,000, a level that it needed to hold. We've talked about this for quite some time. Now it's moving up, and the question is, can it get up to 24,000? On the way down, we talked about the stair steps and the levels of 4,000, where there was support resistance at every block of 4,000. So moving back to the upside, the next resistance point is going to be 24,000. Can it get up there? You look at the LA wave pattern, and we hit a 61.8% wave 5 extension to the downside, and that's holding. 61.8 is my favorite fib level. I think it's the strongest one. Really pay attention to it when I see it on any chart. And so far it's held. We've gotten back above 20,000. That was important because you can see all of this through here, congestion there, right just above the 20,000 level. So can it get up to 24,000? Maybe, we'll see. And then if we get above 24,000, now you've got something going on, because the next level is 28,000 and this little bit of a gap. And I know Bitcoin trades 24/7. I get it. But just like the futures, currencies, etc., there's points in time where you do an end of day print just so that you can have charts like this, end of day charts, instead of looking at live charts all the time and see the patterns. But I think that the interesting point here will be, can Bitcoin get back above 24,000? Can it even make it to 24,000? So we put a little bit of distance between the 10-day moving average today, where we had traded there for 4 or 5 days in a row. You can see right at the 10-day moving average. So a little bit of a move up. Can we get back up there? Interesting things here occurring with Bitcoin. If the dollar does pull back, does that help Bitcoin as well as the metals? Looking at the rest of our markets, on the Dow, there's one of the dojis right there. You can see it on the move back to the upside and the potential of moving up and filling that gap. We have another zigzag pattern. So it's kind of doji zigzag day, and the 100% extension here also gets that first initial gap to the downside filled if this C wave completes. But the doji, and then you look at volume, and we thought the volume on the S&P was bad. Look at the volume here on the diamonds, even worse, sloping to the downside. So when you see a doji like that on such low volume, you got to pay attention to that. Can we get these C wave extensions? I just don't think so without more volume. Maybe, but typically when you see dojis like this on really low volume, you have to be really cautious of the potential for them to roll over. It would be really clean if we got up there, hit all these C wave extensions on these zigzags, filled all these gaps, and then we rolled over. Or if we get up there, get those filled, and significant volume comes in and we take out all these wave fours and we're starting a new impulse pattern to the upside. Any of those are viable, and all the chatter, obviously, because of this bounce that we're having here in the markets of the jobs report was better. So maybe inflation is starting to tick down just a little bit and the Fed won't have to go as hard. Still expecting 75 basis points at the next meeting. Will they do it? Will they back off and only do 50 basis points? If the economic data looks a little bit better, how would the market react to that? That'll be really interesting at the next Fed meeting. Looking at the Qs. So here we go up towards this area of 300. Haven't filled this gap. Do I even need to label it for you? You can see the zigzag pattern here as well. So there's another zigzag and the C wave extension, which would also fill this first downward gap on the Qs. So pretty nice march to the upside there on the Qs. It was the worst performing on the way down. So this bounce, obviously, when you're the worst performing on the way down, you're probably going to get the best bounce. I still say that with the Federal Reserve raising rates, when we look at the end of the year, the Qs will have continued to underperform both the SPY and the Dow. But it's nice to see this bounce coming out of the Qs, and the tech stocks getting a little bit of movement. Here's another doji here on the IWM, the small caps. I heard some chatter on the financial networks today of maybe the small caps will be the leaders coming out of it. I don't know. I think the Qs look just as good, if not better, right now. But we are back above 170. Can we make it all the way up to the next resistance level at 190? I don't know. That's a ways away. But let's look at the zigzag here. So they're all the same. You know, all the markets are showing us the same thing. The difference here is on the IWM, the C wave extension doesn't quite get that initial gap to the downside filled. It would have to break just a little bit above that in order to get that filled, but it's not that far away. But it's interesting that that one doesn't quite get just all the way to getting it filled. And there may be a little bit of resistance there at 180. You can see that that was some resistance there on the way up. And then we broke right back through it like nothing on the way down. So could we bump our heads a little bit on 180 trying to get up to that C wave extension? Maybe it can get up there and get that gap closed. Looks less likely that we move to 190, and it's certainly going to be less likely unless we get some big volume in the rest of the market. Let's look at some international markets. Another doji. Even Australia has a doji there. You can see that they're in a three wave to the downside. So the question becomes, are we going to move up and label that wave 4 before we move lower? Not much of a bounce coming out of the Aussie market here. And with that doji, it makes you wonder, is that it? We did make it up to the 10-day moving average for a couple days in a row here. So can we bounce back to the upside? The best thing going on the Aussie market is this pretty good separation here between the 10 and the 50-day moving average. It hasn't really closed up much yet here. You go back and look at our market and put the moving averages on, you can see the 10-day is kicked up a bit. You may have heard me in some of the other recordings talk about one of the rules that I follow. One is no security in any time frame gets very far away from the 10-day moving average. Another is when there's separation that gets to be kind of significant between the 10 and the 50, it's going to close. That gap's going to close. The 10-day will move back towards the 50. Oftentimes it actually hits it, but it at least moves back to it. Look at charts. You'll see it. It's a good trading rule to follow. But when we come back here, look at Australia, you can see that we really haven't done anything to close that gap. So maybe Australia is just lagging a little bit here, and we get some sort of a bounce next week out of the Aussie market, and we move back towards that 50-day moving average. But right now it's a lagger. Canada, there's another doji. So the international market is the dojis, but look at the difference here now. Where Australia was in a three wave to the downside, Canada had 100% extension on the wave 5. That's something to pay attention to. And the fact that we're back above 33 on the EWC means that now we look at 34. Can we get above there? What does that doji mean? A lot of indecision, obviously, right now in the markets. So we look at the moving averages there. You can see, just like Australia, pretty decent separation still between the 10 and the 50 days. So maybe we do get back above 34 on the EWC in Canada and start to move back up, and maybe, fill the second downward gap here, which would be the first gap to get filled on the way up, like our markets have done. International markets haven't done that yet, but ours have. Thought I would show you the FXI because the China market, all the news there coming out of lockdown, the Chinese government taking it a little bit easier on their big companies, and they're opening up travel back into China so that you can do a little more commerce there. So it seems like you'd want to pay attention to what was going on in China. And that's a pretty nice looking march to the upside. Now we have a pretty significant ascending triangle here on the FXI. So when I see that, the first thing I want to look at is, where's the ADX? Is it low enough to look at a strangle with this triangle pattern? The ADX is just a little too high for me. It's being stubborn. I prefer to see that ADX below 15 when we have heightened volatility. If the volatility is low, I want to see it below 13. We closed just below 25, but that's still heightened on the VIX. So with that, I say that you're better off probably letting it break out and then trading it directionally on the breakout rather than putting on a strangle. The great thing about the strangle is you don't have to pick a direction. It just makes money regardless of which way we move. But when the VIX is higher, the options are more expensive, and that makes it a little bit more difficult. You need just a little bit more of a move. So we like to do that. Love putting on the strangles on triangles. It's a great strategy. But when the VIX is just a little bit lower, it works a bit better. Looking at India, doji there too, not quite as clean as some of the other international markets, but it's still there. And you can see the 10-day moving average marching back up. Pretty interesting that India is making a pretty decent move back to the upside. We are at some resistance here, though, where that wave 3 low was. So we got to break above that. So we've got a little bit of consolidation here, which makes sense. We got a little bit above the 10-day moving average. So we're consolidating, letting that 10-day moving average catch up. Can we make a run? Can we try to run up towards 41 here on the INDA? If it can get above that, then maybe we have something going there in the Indian market. But 38% wave 4 correction yields a 61.8% extension on the fib level there on the wave 5, as I mentioned earlier. And that's exactly what happened on the INDA, just dead spot on. Germany, poor Germany, the EWG just has had not gotten a break in the last 2 years, just down, 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 LE wave patterns all over the place. The 5s relabeling to 3s and moving down lower and hitting new wave 5s. It's just been constant, been pretty rough on the German market. So we got a bit oversold down here on the 5th of July, but we're back up here now towards the 10-day moving average. Still some separation, not quite as much as there is there on Australia and Canada, but still some pretty good separation here. So maybe we get a little bit more of a bounce out of EWG. It'd be nice to see it get above 23. It's going to need to do that. But look, as soon as it gets above 23, it bumps its head again at 24. So rough sledding there for the EWG to try to make a bounce. But at some point, it's probably going to come up and label that wave 4. I submit again that we need to have a lot more volume come into the markets for these moves to the upside to sustain the sell. So I thought we'd finish up here with the VIX with this downward move, big downward move today. And you can see this huge triangle that we had on the VIX. And question becomes, with this bit of a follow through to the downside, how low can the VIX go with all these dojis? Is this a bit of a head fake with this moving down? Or the dojis don't necessarily mean that you're going to get a reversal in direction. Remember that a doji simply means indecision. And oftentimes you have a doji and then you get a sprint back in the same direction. It doesn't always have to be a reversal. So those dojis could show that, hey, we have big moves to the upside at the beginning of the week and the VIX does come back down. We have to pay attention to that with the fact that we had a break out to the downside of this triangle and a bit of follow through there. So we could be looking at the potential for the VIX to move back down to 20. That would likely complete all of those upward zigzags that I showed you. Maybe we get a little bit more volume. Maybe we get even a little bit more out of it. But I think right now we would have to say that there is pretty good likelihood that those C waves on all those zigzag patterns get completed. So a little bit more of a bounce. Again, the question, does volume come in to support it? And what do those dojis mean? A big jump to the upside or reversal, or just more of the same? It's just people are undecided on where things are right now. That's the definition of a doji anyway, indecision. All right, that's what I wanted to share with you this evening. So Zach, if there's any questions, I'll go ahead and take a couple of those now, and then we'll let people get to the rest of their Friday night.
Absolutely. Sounds like a plan. And thanks again for the special live event of the EWO US market update. We have a question here from Halls. Is it surprising that the VIX is this low with all this fear in the market? So I figured that'd be a good one to pass through as you have that chart up now.
Yeah, it is to me. I'm a bit surprised to see it break to the downside, but then you see all of those zigzags to the upside that do have a little bit more room to run in the C wave. And when you get that many zigzags, it's just not one or two. There's so many of them, and they're all in pretty good B wave corrections. And then the extensions, the possibility of going up and filling those is there. I think when we come back and look at the VIX, we still come back to, is this it? Peppering this 35 level so often, is that enough to have put a bottom in the markets? I mentioned that it's possible with the LA wave and Fibonacci levels that have been hit. It doesn't feel like the bottom's in to me, but hey, maybe that's enough reason that it is. If enough people think that it's not, then maybe it is. It is surprising to see the breakout. I'm with you there to the downside, and that's a pretty significant move down in the VIX. So I can see lower VIX, get those C waves fill that gap. Then I think it gets really interesting in the markets from that point. But the question mark still is so many dojis. All this could change in Monday's trade. So, enjoy the weekend. Monday's going to be quite interesting. I didn't mean that. I'll take another question or two. I didn't mean that we were done. Oh, I didn't mean to confuse you there, Zach.
No worries at all. I was just going to say there's a funny comment that came in here from Tony saying if we ever get a 10% move up, you have to wear a bandana. So the new demand.
I'll do it. I've done it before, the bandana with the, this is totally off the subject, but everybody talks about the Chuck Norris thing with the hat and everything else. But for several years for Halloween, after the Pirates of the Caribbean movies came out, I got the Johnny Depp Captain Jack costume and wore that a lot. That was a lot of fun. So I have a bandana, so your deal's on.
Perfect. Sounds like a plan. Crawford just made a statement saying that the recession is extending. So maybe if you want to offer some thoughts there.
Well, we'll find out for sure, right? The next GDP report comes out July 28th, and that's going to tell us whether or not it's official. The Fed's GDP watch tracker that has it's the Atlanta Fed that has it, has gone from, they felt like second quarter GDP would be up 1%, then they revised it to flat, and now they revised it to down 1%. So if we get that second quarter of official negative GDP, then that's an official recession. I know it feels like one. And we all know the inflation, et cetera, have had a little bit of break with oil. We'll feel that a little bit more in the gas pump over the next week or two, hopefully with lower gas prices. But yeah, it sure feels like we're in a recession. The question still remains, is it an official one? Who cares whether it's labeled official or not? We're the consumers. We're the ones that are, paying the higher prices. We're seeing there was a slight tick up in layoffs, even though everybody focused on the payroll numbers coming in better than expected. But all that'll change if the recession does extend. So I think there's hope right now that it's a weak recession. But if you're right and the recession does extend, perhaps we just go up, fill those gaps, and then we roll over and make new lows. And then I get my big spike in the VIX that I've been looking for so long.
Absolutely. So TGO1 says, Rob, it seems Amazon is getting tired of its run up and the triple Q chart usually follows the same. Any bias to the downside next week? Thank you.
Yeah, let's take a look at Amazon. And, we were chatting about this last night as well. when you have a big split like this, and Google has one coming up, this one we were talking about, when you have these huge splits, even if you love the stock, and we know everybody loves Amazon, and it's probably going to perform better than most of the retailers coming out of this, if we do start to come out of it. But when you have that many shares in a split, people tend to sell some of them off and bring some money in and then hold some. So you go through this period where there's selling from after the split. Normally, when you look at splits, I used to trade splits a lot. When you have like a 2-for-1 split, the idea of a split, it doesn't benefit you financially at all. You have twice as many shares at half the price. So it's not a financial benefit on the split. But what normally happens, because they split it to make the shares more attractive to the majority of traders, usually then people step in and start to buy. And right after the split, you get a run up. But not when you have these massive splits, because so many shares are being awarded for everyone, 20 for one, whatever, then people tend to sell some of those and hold some shares. So you go through this period of gyration here of people that want to buy at the lower price, people that are selling that had shares, and you bounce back and forth like this. And so you comment on, it looks like maybe it's tiring. We're also bumping our head against the 50-day moving average there on Amazon. And I would agree with you. To me, you want to see it move above 120. So I'm with you that this doesn't really mean a whole lot. We're pretty much in a trading range if you want to get really technical about it. From 100 to 120, we've just been bouncing around. But if Amazon could get above 120, then we have something going. And you look at the DMI and the ADX is supporting what you're saying. There's really not a whole lot of interest in this move. Maybe it's trying to tick up a little bit, but that positive directional indicator came down. That's the short-term gauge of buyers versus sellers. So I'm with you. We could very well bump our head about at 120, but if Amazon get above 120, we got totally different scenario, and then it becomes attractive and interesting again.
Absolutely. So next we have a question from Polar saying, with the ES hitting 39.20 a few times, do you think sellers are defending it?
Yeah, I do. Not letting it get away too much. But it's easy though, right? Because there's no volume to the upside. So sellers are really smart. I've talked about this a number of times. Sellers take the most risk of anybody, right? Because when you're short selling, you have unlimited risk. So people don't survive as short sellers over the long haul unless they know what they're doing. People come and go. People can try short selling, but I like to listen to some of the guys that have been short sellers for a long time, because they tend to have the acumen to have survived. And so I put some weight in that. But right now it's pretty easy for the sellers. I think they'd kind of like to see it drift a little bit higher, and then they're not going to have much of a hard time pressing their bets back to the downside unless some volume starts to sneak in. So right now they're just kind of, patting it a little bit. But for the most part, the big sellers are quiet right now.
All righty.
All right, let's do one or two more and let everybody go.
Yeah, no worries. So we have a question here from Conscious asking, Rob, would you mind taking a look at Apple?
Not at all. We haven't looked at Apple in a while, which is amazing, because that used to be one that we looked at every single week. But I can see why you want to look at it. You probably heard on the networks that Apple was doing well, moving up to the upside. Now, the key was 150 held for so long on the way down, right? And a lot of people thought, when we came down here in March and we bounced up, that was it. The downside was over with. We came down, we broke below it, tested it again there right at the beginning of June, fell back down to 130. Now here we are testing it again. And we have this, is that a qualified zigzag, or does that one get disqualified? It's a pretty deep drop there. Now, still okay. But look what happens here. The C wave extension, which we almost hit today, is right under 150, which means I think Apple's going to have a hard time getting above 150. There's going to be some resistance there, the completion of that zigzag. Now, C waves can extend, right? They can go to the next fib level. It can go to 161.8. But coming back up here to 150, that's what I want to see. Nice to see this 10-day moving average coming back up. Again, we had the separation here between the 10 and the 50. that's what happens. This is a good example of what I was talking about and how the 10-day comes back towards the 50. So Apple's going to have a little more of a difficult time here coming up with the completion of that C wave on the zigzag and the resistance at 150. But as we talked about with Amazon, if Apple can get above 150, then you got something working there as well. But for now, it's an oversold bounce. It was a vertical move to the downside. The gaps are filled. Going to be a lot tougher sledding for Apple moving forward, but get above 150 and maybe you won't take a look at it. Let's do one more.
One more. All right, we'll finish off with this last one. I will say there's been lots of positive feedback for you taking the time to do this live session on Friday night. So just wanted to make sure I passed that through to you.
Well, I'll turn that right back on everybody. Thanks for spending time on your Friday night to listen to a guy with a cowboy hat on. I appreciate it.
Absolutely. So we'll do this last question, which is kind of more of a conceptual question, might be a good one to end on. From Liberty, question: my concept of a gap is the difference between a stock's daily close and the following day's open. My charting platform identifies gaps using the daily high and the following day's low. What is your concept of a gap?
Yeah, that is a really good question, and it is conceptual. For me, it's the low of the previous day and the high of the current day. So I don't look at closing prices. So it's wherever the low was, like right here on Apple, it just happened to be we closed on the low, but the low of the previous day, and then you have a gap open the next day. And during the next day, the high of that day never makes it to the low of the previous day. And I think you'll find that's how most market makers and floor traders look at it. That's how I was taught it, learning from ex-market makers and floor traders. I talk about this a lot, that you want to find retired floor traders and market makers because they tell you the real scoop on how things work. The ones that are current, they don't want to share, what really goes on the floor is so much because they're still working. But we have AI. We have an AI strategy, by the way, at EWOtrader.com. I think we're kind of leading in that area. There's a lot of conversations been on CNBC that AI is probably the future of technical analysis. We already have a system because we have AI programmers that happen to be traders as well. So we've got an entire alert system that's based on AI, but the AI did a study on, because I'm always talking about gaps get filled, and the AI data came back that 94% of gaps get filled. So it's not 100%, but man, when you see a gap, there's an extremely high percentage chance that are going to get filled. But that's one of my big talking points. So thanks for asking that question, and good on you, Zach, for picking that one to finish up on. But thanks, everybody. I know it's getting late on Friday night on the East Coast, and so as turning it back to you, thanks for spending some time on your late Friday evening for doing this. I'm glad to hear that you like these. We will sprinkle these in from time to time. The only difference between the live and doing the recordings is, we put in a few more doodads and other things in the recordings that we aren't able to do in the live one. But it's great to do this every now and then and have you guys an opportunity to ask live questions. And this is exactly what happens on Tuesday night with Trade Finder. So if you like this format, sign up for Trade Finder and we'll do it every Tuesday night. Thanks, everybody. Have a great weekend.